The flaw in the tax code, realization. To understand how the wealthiest individuals spend millions without paying income tax, one must understand the foundational distinction between wealth accumulation and taxable income. In the United States, the tax code does not levy taxes on the appreciation of assets. If an investor purchases a stock or a piece of real estate and its value increases by $10 million, that investor's net worth has grown, but their taxable income remains unchanged. Under tax law, a tax liability is only triggered when a transaction is realized, meaning the asset is sold for cash. Until that sale occurs, the gains exist only on paper, making them completely invisible to the Internal Revenue Service. This realization principle is the structural foundation of the modern financial system, and it is the primary mechanism that allows asset owners to experience massive economic growth while showing minimal taxable income on their annual filings. Phase 1. Buy and hold the right assets. The first phase of the playbook requires a deliberate shift away from selling labor for a salary. While wage earners are taxed immediately on their cash compensation, those who build wealth by appreciating institutional-grade assets. The preferred assets for this strategy are public equities, real estate, and private business equity. These assets are selected not only for their growth potential, but for their liquidity and utility as collateral. Unlike a W-2 salary, which is subject to high marginal tax rates before the funds ever reach a bank account, these assets compound tax-deferred. By holding these investments long-term and refusing to sell them, the investor avoids the annual drag of capital gains taxes, allowing the entirety of their capital to compound uninterrupted over decades. The power of compounding without tax drag. The mathematics of tax deferral explain why selling assets is structurally disadvantageous. Every time an investor sells an asset to fund their lifestyle, they trigger a capital gains tax of up to 20% federally, plus any applicable state taxes and the 3.8% net investment income tax. This transaction cost acts as a severe drag on the compounding velocity of their portfolio. For example, if a portfolio worth $10 million is liquidated to fund a purchase, millions are lost to taxes immediately, leaving a significantly reduced capital base to generate future returns. By keeping the assets fully invested, the compounding engine remains at 100% efficiency. The ultra-wealthy treat their asset base as a permanent engine for wealth generation, resolving to never shrink the principal through voluntary sales. Phase 2. Borrow against your wealth. The central challenge of holding assets long-term is liquidity. An investor cannot purchase a home, a business, or a lifestyle with shares of stock or real estate directly. To resolve this, the wealthy utilize debt. Instead of selling their shares to generate cash, they pledge their portfolio as collateral to secure a securities-backed line of credit, or SBLOC. Under the Internal Revenue Code, borrowing money is not classified as a taxable event. When a bank extends a line of credit secured by stock or real estate, the borrower receives untaxed cash. Because the funds are structured as a loan rather than income, the transaction triggers zero income tax liability, allowing the borrower to access millions of dollars in liquidity while keeping their underlying portfolio fully intact and compounding. The microeconomics of asset-backed debt. For the average consumer, debt is often expensive and carries significant risk. For the ultra-wealthy, asset-backed debt is highly optimized. Because the lender has direct, liquid collateral in the form of blue-chip stocks or commercial real estate, the risk of default is exceptionally low. Consequently, private banks offer interest rates on these lines of credit that are exceptionally close to institutional benchmarks, such as the Secured Overnight Financing Rate, or SOFR. The lender establishes a safe loan-to-value ratio, typically allowing the borrower to access 30 to 50% of the asset's value. This structural cushion protects both the bank and the borrower from daily market volatility, ensuring that the credit line remains secure even during minor economic downturns. Living luxuriously on untaxed credit. Once the asset-backed line of credit is established, it functions as a highly flexible personal bank. The borrower can draw down on the line of credit to fund real estate acquisitions, venture capital investments, or daily living expenses. To service the interest on these loans, the borrower can utilize the natural cash flow of their portfolio, such as stock dividends or real estate rental income, which are often taxed at lower preferential rates. Alternatively, they can simply allow the interest to accrue and be added to the principal balance of the loan, provided the underlying assets continue to appreciate faster than the interest rate. This allows the investor to maintain an exceptionally high standard of living using untaxed credit, completely bypassing the need for a taxable W-2 salary. Phase 3. Die in the stepped-up basis loophole. The final phase of the playbook addresses how the accumulated debt is permanently resolved without triggering a massive tax liability upon the owner's passing. Under Section 1014 of the Internal Revenue Code, when an individual dies, their heirs receive their inherited assets with a stepped-up basis to the current fair market value on the date of death. This means that all of the capital gains that accumulated during the decedent's lifetime are legally erased. If the heirs choose to sell a portion of the inherited assets immediately, they pay zero capital gains tax. They can use these tax-free proceeds to pay off the outstanding low-interest loans that were used to fund the decedent's lifestyle, leaving the remaining debt-free estate to compound for the next generation. Replicating the playbook for high earners. While the buy, borrow, die strategy is often associated with billionaires, the underlying financial principles can be scaled down for high-earning professionals and upper-middle-class families. Anyone with a taxable brokerage account of $500,000 or more can establish a pledged asset line with a major custodian. Similarly, real estate investors can utilize cash-out refinances to extract untaxed equity from appreciating rental properties to fund further acquisitions. By focusing on accumulating high-quality, liquid assets and learning to use conservative, asset-backed debt for liquidity, individual investors can reduce their reliance on heavily taxed ordinary income, systematically building and preserving generational wealth.